基金投資同人生規劃一樣，可以根據唔同嘅人生階段而作出改變。
所以我們做基金投資必須做好風險管理和資產配置，只有長期有紀律的投資，才能給投資者帶來可持續的回報。
參與富途基金節，距離財富更進一步。
12月6號，富蘭克林特討論。
Morgan Stanley、
維利基金、景順投資、
小炒王梁心欣、
華夏基金香港、
富達賽富途等你。富途基金節，
富途基金節，
富途基金節，
富途基金節。
基金投資同人生規劃一樣，可以根據唔同嘅人生階段而作出改變。
所以我們做基金投資必須做好風險管理和資產配置，只有長期有紀律的投資，才能給投資者帶來可持續的回報。
參與富途基金節，距離財富更進一步。
12月6號，富蘭克林特討論。
Morgan Stanley、
維利基金、景順投資、
小炒王梁心欣、
華夏基金香港、
富達賽富途等你。
投資全球好基金，財富增值再多點，又翻到嚟咧，我哋嘅富途基金節啦。今日咧已經嚟到第5日啦，我哋最後一場嘅呢個基金節嘅直播啦。我諗咁多位朋友仔咧都覺得有啲唔係好捨得，唔緊要嘅，因為咧我哋喺下個星期咧仲有好多場嘅呢一個普通話場次嘅，咁所以咧粵語場次完咗之後，下個星期都可以支持我哋普通話嘅場次啊。咁記得咧要喺翻象基金節嗰度咧睇翻個時間表，就知道有啲咩直播啦。咁我哋咧最後一場嘅直播咧都壓軸咧請咗一位外籍嘅嘉賓嚟同我哋傾下嘅。呢位外籍嘅市場策略師咧就係紐約梅隆投資管理高級市場策略師 Lale Akoner。Let's just welcome Lale to our show. Hi Lale.
Hi, how are you?
咁我知道咧，佢係而家咧係喺倫敦同我哋咧係做緊呢一個直播㗎。咁同一時間咧，咁多位朋友仔咧，如果想要一個翻譯嘅話咧，其實咧我哋即場咧都有我哋嘅同事咧做緊一個普通話嘅傳譯㗎，所以大家唔需要擔心，可以一度聽英文，亦都可以聽呢個普通話嘅。So now maybe we can have a little bit chat with Nade first. So nice to meet you, Lale, and we know that you're our last speaker here for our Hong Kong side live show of our Fun Week. We're really happy to have you here. Can you introduce a little bit about yourself and BNY Mellon?
Sure. Well, thank you very much for having me. It's such a pleasure to be here. My name is Lale Akoner. I work at BNY Mellon Investment Management as a senior market strategist. As BNY Mellon Investment Management, we manage around $2 trillion of our clients' money. We have 8 investment firms, 8 investment boutiques that are specialized in different parts of the investment landscape, and I work as a strategist in terms of understanding what are the trends in the markets and the economy.
Sure. So I think at this moment we would like to know more about the topic of what are we going to talk in this show. 今日咧，我哋會講多少少咧，關於呢個2022年嘅投資展望嘛。Lale, shall we have like a brief introduction about how's the 2022, like the forecast of the macro and microeconomic of the outlook of the 2022?
Absolutely. I would love to give the forecast. We as a group, again, look at markets and the economy and make predictions about how the economy will react in terms of, again, central bank policies or the new virus strain that we are dealing with here in the UK and other parts of the major developed markets. So I will be giving you an overview of the performance for both markets and the economy. Shall we maybe move to slides?
Sure. So now we are on the 6th page. Are we on the same page now?
Yes, I cannot see the slides, but okay. I guess starting with the outlook and how we think about the markets. Look, we're on second page, by the way, right now. So I'm going to, again, talk to you about, as BNY Mellon Investment Management, how we view macroeconomy and markets. Obviously, one of the most important parts in understanding, again, how the global economy will behave is understanding how inflation is going to behave. And most importantly, again, how central banks will be able to deal with inflation. Here in the UK, we have Bank of England policy that is going to be determined probably next week, and markets are still pricing in a rate hike by the Bank of England. It is really uncertain in terms of, again, having a new strain here in the UK and whether the bank will take that into account. But it's a top of the mind issue everywhere in major developed markets at the moment. So I will be talking about inflation, and then we will move towards market performance and pricing, which obviously is very important for managing our clients' money. It's one of our most popular parts of our presentation. So I will spend some time there. If we can move to slide 4, please.
Sure. Okay.
So, look, I mean, for 2022 macro outlook, we have 2 key indicators that we watch out for. It is, again, inflation and central bank policy are the things that it will be determining the outlook for 2022. And 2 factors will have input to that outlook. One is supply chains, and to what extent they're still vulnerable to new outbreaks of the virus. As you guys know, there were major global factory shutdowns that hit global input prices, the global input production, and that led to inflationary pressures in 2021. So we are trying to understand whether those supply chain issues will continue and persist in 2022. The second factor that is, again, a very important indicator for understanding global markets and macro in 2022 is the excess savings of consumers and businesses. So because of these governments helping out people during the pandemic, there's a huge amount of excess savings in part of consumers that are basically sitting in their bank deposits. And we are trying to understand, and just to give you a sense of the amount of those excess savings, excess money that people are not using to spend for anything, not using to pay down debt, not using to buy a house. They're just sitting in bank deposits. And just to give you a sense, it's at around 15% of GDP of developed markets. So it's a huge amount of excess savings. And that's an indicator that we are looking to understand whether inflationary pressures will persist, because presumably if consumers and businesses start to spend those excess money, excess buffer zones that they have accumulated during the course of the pandemic, inflationary. So again, supply chains and excess savings by consumers are the places that we look out for understanding the macro outlook for 2022. So for those of you who have maybe heard about our work, we look at the world economy and markets in scenarios. Here you're seeing 4 scenarios for how the world economy and markets will behave. We are saying that, when you look at markets, people always make predictions on probabilities of what might happen in the future. And of course, the virus is very uncertain. We have a new strain here in the UK. It's doubling every 2-3 days. A lot of people are trying to get their booster vaccinations to be able to be protected against the new virus. But at the end of the day, even the epidemiologists are not certain how that strain of the virus will behave. So when the pandemic started, we said, we are not medical professionals. We cannot predict how the virus is going to behave. So therefore, we will take a look at 4 different scenarios for the world economy and for markets. So essentially, what we are saying is that, look, inflation is a big factor in understanding markets and the economy in 2022. And of course, inflation comes from 2 parts, right? As I said, it could either come from demand side, where people are going to spend their excess savings, and that is going to have a increased demand and therefore increased inflation. But it will also come from the supply side, where these supply chains are going to persist, the supply chain disruptions are going to persist, and therefore there is going to be inflationary. So basically, in the scenarios here, the second and the third scenario, we're saying that, there are increased inflationary risks out there. It ultimately will depend on how central banks will take care of those inflationary pressures. And our main scenario is that, the Bank of England is, in terms of understanding how global major central banks will deal with inflation, Bank of England is still expected to be ahead of the game in sort of tapering and tightening the monetary policy. Markets are still pricing in a rate hike next week, but we as a group are believing that actually they will not deliver that rate hike because of the new virus here in the UK. As I said, it's doubling itself every 2 to 3 days. We are expecting a rate hike in February by the Bank of England. But Bank of England will be the first bank to hike interest rates. Then comes the Fed. As you guys know, they have started their tapering in terms of decreasing their purchase of assets. And we are thinking that tells us that the Fed is probably going to start hiking in the second half of next year. So again, depends on that demand and supply side of understanding the inflation, and they will be looking at again whether consumers are going to spend those excess savings that they're not using, that are sitting in the bank deposits, and whether supply chains are going to persist when they are going to decide when to hike rates. But our main case scenario is that they're going to hike rates in the second half of 2022. Next slide, please. So of course, for us, understanding about macro is important to gauge what it means for our investment conclusions and for understanding markets, basically. So what we're saying here is that, look, equities are still the most attractive option in risk assets. They have a TINA quality about them. By TINA, I mean there's really no alternative to equities in terms of the risk assets. They're really providing us attractive opportunities. Therefore, there is no alternative. You have to be exposed to equities in 2022. And they are a good hedge against inflation as well, as long as inflation is not about levels that are 5%, 6%, they're still good hedges. So we're saying to our clients that, look, be exposed to equities. In the US, we're saying that, you have to be exposed to, because of these, supply side pressures persisting and putting an upward pressure on inflation, you have to have exposures in the short duration parts of the economy. By that, I mean that because we're saying with these inflationary pressures persisting and the central banks hiking rates, we are going to have yields in the US moving higher. That tells us that, and the yield curve is going to steepen. That tells us that the shorter duration parts of the market, where the cash flows are returned to investors in a faster fashion, are going to perform. And for that, we mean cyclicals, obviously. It's industrials, materials, it's financials. Financials had a very good year in 2021, but we do expect still a very good performance from them in 2022, just because they are going to perform with those, higher interest rates coming up in 2022 due to major central bank tightening of monetary policy, as I said. At the same time, we're saying that, yes, have this core exposure in value tilted parts of the economy, but understand that, there might be increased volatility in the markets, and we are seeing it at the moment due to, again, the Fed tapering guidance. The Fed is expected to actually increase the pace of their tapering next week. So that is putting on the shorter end of the yield curve, where the 2-year yields have spiked up. And that is leading to a lot of market volatility at the moment. So how can you weather this volatility in your portfolio? We're saying that you have to have exposures to high quality, low price volatility parts of the growth sector, of the tech sector, and also obviously minimum volatility parts of the market as well. And you have to be exposed to higher dividend yields as well, as I've said, in the value tilted part of the market. So have these exposures for 2022, I think is going to help you have a very good risk-return profile for your portfolios. For the US dollar, we're saying that, look, I mean, of course, the upside for the US dollar in 2022 has become a little bit limited because we have seen an almost 7% appreciation in the US dollar against major FX crosses. And that tells us that, you know, the upside might be a little bit less, but we're still saying that the US major currencies is going to be on a appreciating bias, on a strengthening bias. And that is because, again, going back to my previous points in the presentation, that is because we still expect the Fed to tighten faster than the markets are currently expecting. Again, next week, there is the policy meeting by the Fed. We are expecting them to increase the pace of their increase the pace of their tapering, and you know probably also increase the pace of their hikes next year. So what does that mean? That tells us that the US dollar is probably going to perform better than other crosses because other central banks are a little bit behind. I'm talking about the ECB and the Bank of Japan. They're a little bit behind the Fed in terms of either tapering or in terms of hiking rates. So that tells me that with foreign exchange, you always have to take into account that relative tightening of monetary policy by a central bank vis-a-vis other central banks, in this case, obviously the Fed and the Bank of England, the ECB and Bank of Japan. When we talk about how yields will behave and how sovereign bonds are going to behave, of course, we're saying that, look, we still expect the inflation expectations and higher inflationary pressures to globally put pressure on developed market sovereign bond prices in 2022. That's still the case, and we have seen that happen in 2021 as well. And we're saying that, you know, G4 central banks, and by G4 what I mean is US, UK, Germany, and Bank of Japan, are going to increase the reduction of bond purchases, so the demand is going to decrease, which is putting a downward pressure on prices and an upward pressure. But take into account that the bond issuance, the supply side of the market is also going to decrease. So that is putting an upward pressure on prices for sovereign bonds. That leaves us with a little bit of a mixed picture. But overall, we're saying that because the demand side is going to be more than the supply side reduction, we're thinking again that developed sovereign bond prices will go down, are going to move higher. And that means that also the curve against, you know, in markets is going to steepen as well. So we're still saying that, you know, in equities, because the curve is going to steepen, you have to have a higher exposure in shorter duration parts of the equity markets. Again, those stocks that will return their cash flows to the investors faster. I'm not talking about tech. They take a long time. I'm talking about, again, financials, industrials, materials, and other value-tilted parts of the economy because of our central view on how sovereign bonds are going to behave. And for international developed equities, we're saying that, look, ex-US, it is extremely important to have exposures in international parts of the equity markets. It's very important to have exposures for diversified portfolios. For Europe, we're saying that be mindful of this new virus. It is very new. Of course, there's a lot of uncertainty in terms of understanding how it's going to behave. Hopefully, the preliminary data indicates that, you know, the severity of the virus is lower, and 3 shots of a vaccine is going to be useful in, you know, not having to go to the hospital, having a mild disease. So that is good in the sense that we're saying overall that the sensitivity of economic activity to the virus has diminished thanks to all these vaccines that are very much high in supply. But again, there is a bit of an uncertainty in understanding how much of a mutation has the virus been through. In Europe, this is most important because you have to understand that the stock market is showing that, lower sentiments a little bit. The breadth in the market has deteriorated in the past few weeks. We're thinking that, the percentage of stocks that are above their 200-day moving averages is now around 65%. And to give you a sense, it was around 90% this past summer. So Europe is getting a little bit more worried about the news. Of course, the fact that major central banks are going to start, tapering and hiking interest rates, that means less liquidity for the markets and less upside for returns for the markets. So again, another reason for that weakening in breadth in the market that we're seeing here in Europe. I always say emerging markets exposures are very, very important because, the asset class is so heterogeneous. The inter-country correlations are very low, which is very good for active asset managers like us in, capturing alpha opportunities. But you have to understand in emerging markets that the overall external risk environment has become a little bit, it's a little bit mixed picture at the moment, because obviously when you take out that major liquidity out of the markets, that is going to hurt emerging markets equities. We are seeing a rise in U.S. yields, U.S. real yields for the next year. To my point before about the U.S. dollar outlook, as long as the U.S. dollar outlook stays, firm, that is not going to help emerging markets a lot. And of course, most importantly, again, is China growth trajectory. A lot of these parts of Asia are very sensitive to how the China output, China economic activity is going to behave in 2022. And there are risks that, again, those risks that are coming from the property market due to Evergrande collision. So it's a mixed environment for emerging markets. But I'm always saying that you have to understand that it's a great asset class in terms of capturing that opportunities, and there are good places to invest in emerging markets. And I'm saying that for the next year, earnings growth in emerging markets are going to be led by Asia. And when you look at Asia, of course, there's China and North Asia that are very much tied to how China behaves, but then there's South Asia and East Asia, and there are places we like in South Asia, such as India, where there's really low policy uncertainty. There are great reforms being implemented on the supply side of the economy, where Modi is making things easier for companies to make business. This is very positive. And the fact that there is no election in the near future, that tells us that Modi will implement those reforms that will even make further improvements in both the demand and supply side of the economy. So we are quite optimistic about India. And when you look at the larger and that consumers are coming back very strongly, that tells us that in pieces of the markets such as consumer discretionary, consumer staples, they're going to behave quite well in 2022. You have exposure in these two sectors. And of course, Asia, really good, really strong names in the growth sector, in the tech sector, with exciting innovative companies. You have to have exposure in the growth parts of the sectors in Asia as well. So next slide, please. So of course, I talked about two factors that are going to drive our the outlook for 2022. One is that, again, excess savings. When you look at the income profiles of the US in terms of how much money people are making, how much money is sitting in their bank deposits, we're seeing that again across major developed market economies, there's 15% of excess savings that are sitting in bank deposits of households. So this is the money that is not being spent, that is not being used to pay down debt, that is not being used to buy houses. So what is it? It's probably buffer zone that people have accumulated during the pandemic. And the question for us economists and market participants is that what if that huge amount of excess savings is being spent? That is going to be inflationary. And thinking that, a lot of people are saying, oh my God, but it's those parts of that much money is sitting in the wealthiest markets. But that's not the case. When you look at the income deciles, you're saying that, all the major income deciles have, again, higher excess savings accumulated during that even the lower profiles have these excess savings, which tells me again that because these profiles have a higher propensity to consume because they have less access to credit, again, it's going to be inflationary. Next slide, please. Now on slide 7. So, that's cash on the sidelines is also true for businesses as well. Businesses, households have higher cash on the sidelines, which again tells me that, if we see a major uptick in inflation, that might be coming from the demand side of the economy, from consumers and corporates spending this money. Next slide, please. So we're on slide 8 right now. And of course, we have seen the market moving away from thinking that inflation is becoming becoming more permanent. And that is because those supply side chains are lingering much more than we thought they would be at the beginning of 2021. And that supply side pressures are coming from, again, input prices going up because of those factory shutdowns and other, disruptions in the market. But it's also coming from the labor market, where, labor market is becoming less in an equilibrium, if you will, where jobs, those skills are not being met for employers. So what we call a skills mismatch, where we think that the permanent unemployment has ticked up higher. And it will take time for it to come back to equilibrium. And that is putting an upward pressure on inflation as well. And that's the next slide, in slide 9. Again, we're thinking that the US job openings have come up, but at the same time, those jobs are less easy. They are harder to fill in because of mismatches that started after the pandemic, which could be permanent, and that is putting an upward pressure on inflation. The next slide, please. So we're on slide 10 right now, and again, energy is a byproduct of those supply side pressures. We have seen an uptick in energy prices. Some of it was coming from, China shutdowns and electricity outages, and that led to, an oil, which is a substitute for electricity and natural gas, to go up higher in prices as well. Of course, OPEC does not help too much in the sense that they're not increasing the supply. They're classic OPEC. They're taking advantage of these elevated prices. They did meet last week, increase the supply a little bit, but a lot of people in the market are saying that relative to demand, that supply increases are not sufficient. So we're still seeing elevated prices for oil and natural gas, which is again putting an upward pressure on inflation, and which, in my opinion, is one of the factors that the Fed took into account when moving their guidance in saying that, yes, the inflation is transitory, to no, inflation is actually less transitory than we have expected it to be. Therefore, we will probably increase the pace of our tapering and probably the pace of our hiking cycle as well next year. Can we move to slide 14, please? And of course, when you look at the markets, as I said, it's going to be harder to achieve that return that we have achieved in 2021 in markets for 2022. We're thinking that, as those inflationary pressures have persisted as the central banks are communicating increased tightening of monetary policy in major economies, the market is slowly coming under pressure, and we're seeing that some of these global equity indices showing signs of weakness, showing signs of worsening breadth in the parts of the market, such as, again, the growth sector and technology sector coming under pressure at the moment. But overall, it's still a benign outlook where the corporate credit spreads are still at low levels. We look at credit spreads very closely because they're very early indicators of a major tightening in financial conditions in the markets. And when those spreads come up, when there's a spread widening, that's actually telling us that risk is increasing in the markets, and that puts a pressure on equities. But so far, yes, the corporate credit spreads have widened a little bit in the past 2 to 3 weeks, but they're still at very subdued levels. Shall we look to see whether we can take a quiz now, actually?
Sure, of course. 好，去到呢個時間咧，我諗都俾少少時間嚟休息一下啦。我哋下半節嘅時間咧，應該會同大家講多少咧關於呢個美股市場啦，同埋呢個市場方面喎。呢個時間咧嚟到我哋嘅互動小節啦，咁用翻中文去做翻呢一個環節，好似會好啲嚇。咁呢個時間我哋咧就會繼續玩呢個互動華人節啦。咁我又會講一個牛牛嘅口號，繼續係我講你寫啦。咁記得啦，我陣間講口號之後咧，就將個口號咧喺個牛牛圈嘅評論區度寫低，要完整無誤，唔可以有錯字嘅喎。咁我哋就會咧揾出第88同埋第188位嘅朋友仔咧送禮物嘅。咁第88位嘅朋友仔將會得到我哋嘅象抱枕或者公仔一個啦，而第188位嘅朋友咧就會得到我哋嘅全套嘅牛牛禮盒一個喎，非常之豐富嘅禮物啊嚇！就好似之前嘅慣例一樣，咁多位朋友，如果咧兩個都係同一樣嘅牛友嘅話咧，我哋會順延嗰個禮物俾下一位嘅朋友喎。咁大家預備好咧，我即刻就講出我哋嘅呢一個口號啦。口號就係我諗大家都有聽過㗎啦，如果有睇我哋富途嘅廣告，就係與千萬個你一起富途啊！好，我再講一次喎，與千萬個你一起富途。咁多位朋友可以喺評論區度咧，而家即刻留言啦。咁我睇下朋友仔係咪好？就已經即刻打低我哋呢中文嘅留言先，唔好講呢個，唔好變咗英文喎，唔需要翻譯做英文喎呢句口號。好，咁我再講多次嚇，我哋呢個我講你寫嘅互動小遊戲嘅呢個口號係與千萬個你一起富途。咁多位朋友即刻喺評論區度留言，我哋會將禮物送俾第88同埋第188位朋友嘅。非常之好啊！即刻已經見到朋友留言啦。咁喺呢個時間呢，我哋都可以睇睇。有好多嘅問題啊嚇，咁問題咧，有英文有中文喎，睇嚟都有好多聽開外語嘅朋友啦，都有聽開可能我哋嘅全日嘅朋友。咁今場咧有2個雙語直播嘅，如果咧想聽普通話嘅朋友都可以轉翻去我哋嘅翻譯度聽。如果想聽嘅朋友咧，可以聽翻我哋咧主講嘉賓嘅呢一個發言嘅。咁喺大家咧排除啊嚇，可能呢句真係一句好熟悉嘅口號啊！大家都喺度留緊口號嘅時候咧，我哋又請翻 Lale 出嚟咧，同我哋講多少示範啦。Lale, I will pass the time about maybe about pass the stock.
Great. So you're now slide 15. I talk about a little bit about our view on China. One important, obviously, Chinese stock markets have come under pressure in the second half of 2021. They were performing really well, but in a matter of 2 to 3 months, they those outperformance vis-a-vis other major equity markets because of those risks that were building and coming from Evergrande. But one very, very important development, in our opinion, happened last week. Is basically they cut the required reserve ratio requirements by 50 basis points. This is the second time that, and telling us that they're really using that policy flexibility that they have been talking about when dealing with these, increased risks in the markets coming from the property developers. It's a very, very positive, event in our opinion, and it's basically tells us that sequential growth slowdown that we have seen in China in the past quarter it's going to stabilize in the beginning of 2022 and probably go up a little bit in the second half of 2022. So it's very, very positive. Obviously, there are things that need to be improved. The credit impulse in China is still quite weak, but to the extent that it starts to improve, we still think that the many China-levered parts of the market, either in emerging markets, where in North Asia, again, activity is very closely linked to China, they will start to outperform. Or even in the US, such as in industrials, where, again, very much levered to China growth outlook, and therefore they having that boost from that policy easing that just came out from China. So we are overall becoming more optimistic with this recent indications that the authorities act to fight that increased risks coming from the property developers in China. So we're in slide 16 now. Of course, when you look at emerging markets vis-a-vis other developed markets, I always tell to clients is that, look, the really low as opposed to the US. They are cheap. They are giving us good return opportunities, good alpha opportunities. You have to have exposures to these emerging markets in your diversified portfolios. Of course, I always say that, you know, there are idiosyncratic risks out there for some of the emerging markets, some of the high beta markets that we're seeing at the moment, such as South Africa, such as Turkey, they are coming under pressure. So you have to have a very good understanding in the country, in the sectors that are most relevant for that country's outperformance in 2022. But understand that the multiples are really low compared to when. So away that bias a little bit for as well. Slide 17, again, market spread has come down a little in the sense that, you know, at the beginning of 2021, the reopening behavior where major parts of the market behaved really well, outperformed other equity markets in the US, in EMEA, in emerging markets. But that has come down to the breadth has decreased a little bit in the sense that you have understanding which part of the market is going to behave well. In our case, we're saying that value of short duration of the market is going to behave well as opposed to growth or technology sectors. We're seeing it in the recent data for 2021, where, you know, again, the number of sectors that are performing decreased a little bit. So very focused on parts of the market will be. Of course, now we are on slide 18. That is due to coming up higher, the volatility, and that increased, and that is because, as I said, increased guidance from the Fed and major central banks saying probably need to start our tightening schedule, our tapering schedule earlier than we have previously committed. So that is putting an upward pressure on the VIX, which is again into that breadth worsening I talked to you about in the previous slide. For slide 19, we're saying that what does that mean for the yield curves? As I said, the bond prices are going to come down because the demand is going to diminish from major central banks as they start tapering and interest rate hikes. So we're seeing that the yield curve steepening. In the recent, we have seen a bit of a flattening. The end of the curve has gone higher. Of that increased guidance, the Fed and other banks saying that we might consider hiking and tapering here. So that has led to a flattening in the curve. But overall, for 2022, we're thinking that will lead to a slow steepening of the yield curve, where the part of the yield curve is going to that you have to get exposed to duration parts, i.e., markets of the parts, such as financials, industrials, materials, and even energy, to the extent that the price elevated levels. Of course, now we're on slide 20. you look at yield, very important to understand nominal versus real yields take into account high inflationary pressures. Real yields go higher, that will send inflation low. Hence, that we're seeing in the graph that I told as tells us, as yields go higher, financial conditions are becoming tight. The liquidity in markets are becoming less. That valuations, and again, that's very important in understanding parts of the behavior. 2022. Again, easy are behind us. 2022 is understanding what they're going to behave or how yield is going to behave, and therefore understanding which part of the market is going to behave. You here now slide 2020, slide 21 for understanding 2022. Performance markets. You have to understand again how the major central banks are going to adjust their timing of the rate hikes and adjust their timing of tapering asset purchases to the extent that the Fed and other central banks increase the pace of tapering. That is going to put an upward pressure on real yields and therefore a downward pressure on valuations. So a very important indicator for us is how fast real yields are going to go higher. And slide 22, and this is my last slide, and I really move toward taking questions from you. But basically, again, for major parts of the economy coming down, it is typical for a of the cycle, in the sense that peaked the cycle in 2021. Now growth is going to come down a little bit. We are going to grow across major economies, and that is including emerging markets in Asia as well. But that pace of growth is going to come down a little bit compared to 2021, and that is reflected in earnings growth expectations for 2022. Again, those easy returns behind us have a very vision on understanding how the schedules, how increase in yields are going to be happening on 2022 to understand again which parts of the markets that you need to be exposed to in 2022. So that concludes my presentation. I'm very happy to receive and hopeful that there are questions for me.
Thank you, Lale, for the very detailed presentation. So now let's switch to our Q&A section, shall we? 呢個時間咧，我哋就嚟到呢個互動問答嘅環節啦。我見到唔少朋友就已經喺牛牛裡面嘅直播評論區裡面咧問咗啲問題啦。我哋即刻就睇下Lale應該點樣答到我哋所有嘅問題啦。Lale, let's start with the first question. Some of the audience want to know more about what is your outlook on the U.S. dollar?
Sure. I mean, as I said, U.S. dollar, when understanding how foreign exchange is going to behave, you have to understand that it's a relative price. So for an U.S. dollar versus a euro, U.S. dollar versus other emerging market currencies, you have to understand the tightening cycle and how major central banks in the U.S. is going to behave vis-a-vis other central banks, either in developed markets such as in Europe or Bank of Japan, or in emerging markets. Thinking that because the Fed is going to act faster in terms of their tightening stance, that is going to put an upward pressure on the U.S. dollar vis-a-vis euro, for instance. Euro is coming under pressure at the moment, and that is because the Fed is basically saying that we are going to increase the pace of our tapering in 2022. So that is putting a downward pressure in Europe. In euro. So again, US dollar is going to stay firm in 2022. The upside is limited compared to 2021. It has appreciated by 7% in 2021. It's not going to be like that, but it is still going to stay firm. It's still going to be on a strengthening upward bias for 2022.
睇嚟美元嚟緊都會幾堅挺啊嚇！頭先漏咗同咁多位牛友講咧，就係我哋而家嘅問答環節咧，都係一個有獎問答嘅環節嚟嘅喎，咁所以咧頭3位俾我哋揀選嘅朋友係有禮物收㗎。咁第1位朋友仔咧將會得到我哋嘅象籃枕或者公仔，第2、第3位朋友都有牛鎖匙扣嘅喎，咁所以大家可以踴躍啲發問啦。Let's keep going with our questions. One of our audience want to know more about the cryptocurrency. So do you think cryptocurrency can be a good thing to invest like under the high inflation next year?
Sure. Look, it's really interesting because now that we're seeing that tightening in the markets at the moment, the liquidity is getting tighter and tighter. So I do not actually expect the crypto to see those gains that they have seen in 2021, where liquidity was ample. They have households had really a lot of excess savings in their deposits, so maybe they were using it to buy cryptos and everything. That money is getting to get shrinked in 2022. I'm actually not expecting those gains that we have seen in 2021, but I do understand that crypto is a good place to be if there is no confidence in your central bank in acting against these price stability issues and tackling inflation. In my home country, people take their money out of the Turkish bank deposits and putting it into crypto. So as to the audience, I would like to say that the returns are going to be less, but it's still a good, relevant place to be in a higher inflationary environment.
Okay, let's keep going with our questions. Our next audience want to know more about how do you think about some sectors? So there are 3 main sectors like being a hot topic in the investment market now, which is the tech and the consumer and the medical sector. So the audience want to know that which one do you think is more outstanding in the next year?
Sure, I would have said financials until up to last week, but I have basically we're saying that again value tilted parts of the markets. We're saying consumer discretionary is still outperforming consumer staples, and that is going to be the case in 2022. But be very careful about Omicron. Look at the news headlines very, very closely to understand whether we are going to see another sort of like a slowdown in economic activity with Omicron, because that is going to change investment conclusions in a major way. Our base case scenario is that the vaccines are going to work for Omicron. We will not see major shutdowns in economies due to Omicron. That tells me that, again, financials are going to behave well, although not as well as they did in 2021. If I have to give you a couple names, I would say industrials, because of that rate cut from China. They are going to get a bounce back. And I'm going to say materials, because, again, that economic activity being strong is going to help materials as well. So those 2 sectors, I think, are quite safe places to be in 2022.
Okay, that's a very interesting question. I think let's ask about this one first. So one of the audience want to know that like this year we have so many meme stocks and some upgrading stock that like tech stocks. So one of the audience want to know that do you think the U.S. growing stocks can outperform the market index next year?
This is
Do you think those stocks that with like a very outperforming stock can be outperform the market index, like Dow Jones? Yeah, and S&P.
Yeah, so meme stocks are going to be, again, what we're seeing is a weakening in meme stocks. And the reason why is that credit spreads, as I've said, have gone up. That is putting a pressure on the most riskier parts of the market, such as meme stocks. So they are coming under pressure. I am expecting that to continue in 2022. Meme stocks, in my opinion, was a 2021 story. And the reason why is because there was ample amount of liquidity. Global credit spreads were low, but now we're seeing global credit spreads going higher a little bit with that money, excess money coming out of the market. That is going to put up a pressure on. I would stay away from meme stocks and stick with those high quality, high cash generation parts of the growth, such as software, even semiconductors, but not meme stocks.
Okay, sure. So let's come to the last question for you, Lale. So people want to know about the view on interest rate and how will they affect markets.
Sure, interest rates are going to go higher. That tells me that the yield curve is going to steepen. So that tells me that, again, those parts of the economy where there, shorter duration assets will going to outperform longer duration assets. Again, that is coming from the yield curve steepening. And, again, you have to be exposed to value titled parts of the economy, such as financials, industrials, materials. And that is because, again, taking that main view that the short yield curves are going to be less than long yield curves, long yields. So that tells me again have a very focused view on understanding how the rates are going to behave. But rates are going to go higher, guys. So that is going to put a pressure on some parts of the economy and the markets.
Yeah, be aware of their tapering and let's take a look at what's happening next year.
That's the story for 2022.
Sure. 喺度我都非常之多謝咧 Lale 同我哋答咗咁多條問題。Thank you so much, Lale, for all your presentation and all the questions and answers. So I think we have come to the end of our presentation here now. So 我哋而家咧都已經嚟到咧呢個基金節咧嘅最後嘅環節啦。咁今日咧非常之多謝咧我哋呢位外籍嘅嘉賓同我哋分享咗咁多2022年嘅投資展望啊。呢個時間咧我哋都要讀一讀我哋嘅風險聲明嘅。本節目咧不構成任何證券、金融產品或者工具邀約、招攬建議、意見或者任何保證。直播內容同嘉賓或者主持人嘅個人觀點，作任何嘅投資決策之前咧，都適宜先考慮風險同埋諮詢獨立意見。富途咧係不負責任何之前嘅損失或者係虧損責任嘅。而金融產品買賣嘅虧損風險可以十分之重大，因此咧閣下必須要仔細考慮，鑑於自己嘅財務狀態同埋投資目標，買賣金融產品咧係咪符合閣下嘅。咁今日咧，我哋嘅富途基金節咧已經去到尾聲啦。咁我哋呢邊粵語場次完咗之後咧，嚟緊咧都仲係會有普通話嘅場次嘅喎。咁所以咧，想大家咧繼續要留意翻啊！喺下個星期咧，我哋會喺12月8、12月9同埋12月10號咧，仍然都會喺晏晝時間做直播㗎。咁所以大家咧繼續黐實喺我哋嘅牛 App 上面啦，我哋咧會繼續同大家做直播。記得關注翻我哋啦，同埋留意翻時間表啦。咁我哋咧喺下個星期同一時間咧，普通話嘅場次就會同大家見面啦。今日咧我哋去到呢一度啦，希望大家學完之後都係真係學識投資好基金，同埋令到你嘅財富真正咁增值啦。咁我哋呢個環節去到呢度先，咁再同大家講聲拜拜，下次再見啦，拜拜。
股票突然咁大變動 ，Strong Hold 定 Let It Go？ 投資嘅大小事，梗係要上牛牛圈，同牛友交流心得又得。